Let's take another look here at the North American equity markets. It's definitely been another volatile day. The Dow is off the lows of the day right now, but we were actually in positive territory. So a lot of push and pull right now in terms of politics as well as the Fed. Those are the drivers of the market. Let's also bring up the TSX, though, of course. Joining us now for her take on the market is Diana Avigdor. She's the head of trading with Barometer Capital Management. Diana, great to see you. Thank you very much.
Hi, Catherine. How are you? No problem.
You know, let's just talk about today and what we've actually seen in the market. Let's start with the morning in terms of why the market was actually positive. We heard from a Fed official.
We heard at 10 o'clock they tried to rally. The market wanted to hear something nice out of Powell yesterday or 2 days ago. Nobody minded the rate hike that was expected, but there was a sense of fear that maybe the Fed doesn't understand the slowdown in the economic data. And so today we had New York Fed Williams speak at 10 o'clock, and he assured the market that the Fed is understanding Wall Street worry with the slowness in the data and is taking into account that worry. So markets sighed a sigh of relief this morning and allowed for a little bit of a rally. Rather, wasn't so much buying, it was a bit of dissipation of selling.
Yeah, and then, of course, we've got the downdraft right now happening as well. There's continued concerns regarding a shutdown in Washington, D.C., government shutdown. Here we are again.
Yeah, you know, government shutdowns are not what it used to be. It sounds really bad, but the most of the activities still go on. Some of the smaller activities are not going on, but of course that's a very negative headline. Really, the market is really not getting really tired of the very high octane headlines, political headlines that are going on. And listen, the market, you and I last we spoke, we were right at the cusp of is it going to hold or not? And honestly, the market broke down, and has been relentless degrossing of positions, deleveraging, selling down of positions over the last week as soon as it broke down. And lots of exposure has been taken out of the market. There's been very heavy ongoing selling, and it's going on today as well. We can attribute it to headlines, and we can attribute it to economic data, and it'll all be right. But bottom line is it created a bit of a breach of confidence, and a lot of people are worried that we're going to have some mutual fund outflows, which we've seen this week already, where and portfolio managers are going to have to meet some redemptions. So nobody's standing in to take on any new exposure. So there's no buying out there.
So Diana, it's interesting when you talk about the fact that there is a lot of volume being traded. There are a lot of people actually still at their desks selling. Give us a little bit more detail in terms of what you're seeing, because I think a lot of people would expect that and we know, I mean, a lot of people are also on vacation, but I always say it's never over until December the 31st. So everybody still watch us next week. I mean, that's just the reality of the markets. So you tell me and tell us right now, please, in terms of what you're actually seeing. Who's selling? What are you seeing?
Yeah, you're absolutely right. And we have to be careful when we talk about seasonals, because seasonals work until they don't. So December is supposed to be a really weak volume month. It's supposed to spitter away into the end of the year. Merry Christmas. And, you know, and we've had 17% increase in volume this December relative to last December. Yesterday was the second largest volume day of the year. This quad, which is about 25% larger in volume than the September quad, which is all the expiry of the futures, tends to be a really high volume day, and everybody knows it's a little noisy, but this one is really much larger than any other quarterly, so even relative to itself. What we've seen in terms of selling, we've seen it from all players. We've seen it from vanilla players. That would be the mutual funds. We've seen it in the hedge fund world. That would be those that have been levered. All the quantitative strategies, say those that are asset allocations, you know, bonds versus equities. There've been some degrossing there as well. And started to see some of the retail money, I'm being told, as we see prime brokerage data and so forth, that has started to unwind. Look, we're very oversold. We're down 6% on the week so far. That is, unless we rally into the close, If we close right here, it'll be 6, if not a little bit more.
On the U.S.
So,
markets?
On the U.S. markets,
Okay.
yeah. And with a lot of volume. So we're a little bit oversold, but we do have quad witch. We do have the large closing volume for today, so create some noise. But we've been seeing selling. To your question, who's been selling? All market players have been selling as soon as the technicals broke down, which is what everybody was watching for. From our perspective, we lowered our exposure to almost minimal through cash and cash equivalents bonds, and whatever exposure is left is hedged with index futures. So capital preservation mode is where most people are sitting at right now.
So that's so interesting, Dana, because you know, I know that you and your team will sell out of positions if they hit a certain mark. But the fact, though, that you have, it sounds like you've protected essentially the entire portfolio with cash and using options.
Yeah. You know, I'd love to say that, you know, you can't, the bell doesn't ring at the top. You hear me say this all the time. We don't know. We don't know where the top is. But as the market comes down, we have these stop losses that we have in our minds on certain names, relative strength strategies, and so forth. So as the market declines, some of our stocks get sold by us, of course, with discretion and judgment. But we do in a disciplined way step away. The lower it goes, the more we step away. And at the point where, so markets started going down, September 21 was the day the S&P 500 hit high. And as it was going down, so as we come into this month, we came in with some portfolio, about 20% cash and bonds, because as it was going down, like I said, it keeps going selling. And then as it broke the level that you and I spoke about last week that we were watching at Barometer, that selling for us meant that we had to intensify. And whatever we have not been able to sell, we just hedged out with index futures. Just selling index futures against your long exposure neutralizes some of the volatility in the portfolio. We love to catch the high, but it never quite happens that way. One does not know where the high is.
I'm curious, because I think our viewers would want to know in terms of, okay, if you've got stocks and you can actually protect it by selling index futures, I'm assuming you sold S&P 500 index futures. I would think that a lot of people are out there and have been over the past couple of weeks doing that as well. I would think that that option is probably quite expensive.
Well, it's a future, so you know, the S&P mini futures, there is a fair value calculation, and what you pay for, it's generally one of the most cheapest insurance that you can buy. It tends to just, it's fair value, it's calculated on the time value, of course, so it's a few points away from the cash. And it moves hand in hand, of course. There's absolutely no slippage between that and the actual S&P index. Another option for hedging, if you don't want to be in the futures market or the options market, you can sell short ETFs. SPY is the S&P index ETF, and when you borrow that from your broker, or your retail broker, or wherever you do your trading, you get a borrow on those. Those are generally very cheap borrows, and you just sell short an ETF, which is the same trade as going long, but the opposite way. So you don't have to dibble and dabble in the derivative world if you don't want to.
Because that's a different world.
It's a bit of a different world.
Yeah, it's a different world, and you have to be a sophisticated investor. You have to be approved to be able to trade that if you've got your own personal account. So
yeah, but selling an ETF, this is a vanilla ETF, and it can just take out the tail out of the portfolio. And you don't want to sell all your stocks necessarily just because you have a correction. You may love it long term, but you just want to take some volatility out, and you can do that for half of your portfolio, all portfolio, quarter, anything that you think makes you comfortable.
Yeah, it allows you to make some money on the downside and keep your stocks.
And not lose too much, so you're in it, you feel comfortable. Fear doesn't paralyze you.
Understood. Dana, great to see you. Thanks always for being with us on BNN Bloomberg. Have a great holiday.
Thanks, you too.
Thank you. That's Dana Avigdor. She's the head of trading with Barometer Capital Management.